The fact that gold didn't just take off, it's just amazing. This was such a bullish announcement that the Bank of Japan has already surrendered on its rate hikes, and it's barely above zero. The Fed is also surrendering. They're going to start cutting, but inflation is going to take off just as the economy is officially entering recession, even though we've unofficially been in it for some time. You can't imagine a more bullish environment for gold, for the mining stocks.
Renowned economist and strong supporter of Bitcoin Peter Schiff has made news once more for his critical assessment of the Bank of Japan's latest policy change. The central bank's decision to halt its rate hikes has raised alarms, with Schiff warning of dire consequences, including severe market instability and even the risk of hyperinflation in Japan. This move comes amidst a backdrop of global market turmoil, where last week both the Dow Jones Industrial Average and the S&P 500 experienced their steepest declines in nearly 2 years. The market downturn was largely driven by the unwinding of the Japanese yen carry trade, a strategy where investors borrow yen at low interest rates to invest in higher-yielding assets. Japan's long-standing policy of ultra-low interest rates has fueled this strategy, allowing investors to take advantage of cheap borrowing costs. However, the Bank of Japan's recent hike in its benchmark interest rate from 1% to 2.5% on July 31st has forced many investors to rethink this approach. Schiff didn't hold back, stating, "The BOJ has already conceded its commitment to not raising rates if markets are unstable, but raising rates without destabilizing the market is impossible. Inflation will devastate Japan until the BOJ is forced to crash the markets by hiking rates aggressively." Schiff also hinted that central banks like the Federal Reserve might follow a similar path, potentially cutting rates and reverting to quantitative easing, a move that could have profound implications for gold. Let's hear what Peter Schiff has to say.
Didn't just take off. It's just amazing. This was such a bullish announcement that the Bank of Japan has already surrendered on its rate hikes, and it's barely above zero. The Fed is also surrendering. They're going to start cutting, but inflation is going to take off just as the economy is officially entering recession, even though we've unofficially been in it for some time. You can't imagine a more bullish environment for gold, for the mining stocks, yet gold was down last week. In the face of this, mining stocks were down. So this is just a great opportunity. You know, the dollar ended the week flat. It closed last week on a 4-month low. So the dollar didn't really bounce from there, but it is getting ready to roll over when the Fed, starts to cut, even before it cuts. And it's not just going to cut. It's going back to QE. Nobody is talking about that, but that is what's going to happen because rate cuts aren't going to do it. They're not going to be enough, right? Quantitative easing is going to be required and an even larger dose than before. So the balance sheet is about to go ballistic. So gold should be rising. And so this is an opportunity not just to buy the metal, to buy the physical gold and silver, which you should be buying. You should give the guys over at Schiff Gold a call. Should also be gobbling up these mining stocks. Again, that's where most of my personal money is. Half my personal portfolio is in gold and silver mining stocks. I expect those stocks to just explode. I think the upside potential is enormous, not just 5 or 10 baggers, but bigger than that. Of course, there's risk, right? I mean, I've thought this for a while, but the setup is perfect. The fundamentals are perfect, and nobody is playing this trade. The hedge funds aren't there. Institutions, retail, nobody talks about it, even though it should be, right? Even though gold's at 2430-ish, it's right near a record high. It's barely below its record high, yet it's a contrarian investment to be bullish. That's how bearish everybody is. So it's just, to me, it's the best opportunity I've seen. So you should be buying these stocks. The Euro Pacific Gold Fund, you could buy it no load at Fidelity, Schwab, any of the big discount brokerage firms, or go to Europac.com and talk to my representatives about how to get into our fund, how to get into our separately managed accounts where we manage a portfolio. And also the Schiff, my value fund now it's in the top, I think it's in the top 10%, I forget, maybe 6% year to date. But a month ago, it was near the bottom of the pack year to date. Now it's almost at the top as we're shifting into value. out of all the momentum stocks that I don't own. So the strategies are really coming into play. But what's going to kick them into a higher gear is going to be the weakness in the dollar. Once the dollar really rolls over, it's a whole new ball game when it comes to international investing. And the dollar decline is way overdue, just like the gold breakout. And even though gold has moved up, right, we have hit new record highs, nobody's cared, nobody's paid attention. And most of these gold stocks, now some of the gold stocks hit 52-week highs last week and then got slammed on that big drop on Monday. But again, I think that was just frustration because they couldn't push gold above 2,500. Well, once it gets above 2,500, it may never look back to 2,500, right? Because they just may bid it and it'll run away, given where we are right now.
The Federal Reserve is expected to lower interest rates as soon as next month, a move that could bring relief to those with mortgages, credit cards, and car loans. However, the road to this decision may be bumpy. Last Friday's weaker-than-expected jobs report triggered a sell-off on Wall Street, leaving the markets in a fragile state as they attempt to rebound. Uncertainty remains about how aggressively the Fed will cut rates when they meet in mid-September. Although the Fed has not yet made any immediate rate cuts, Peter Schiff notes that the markets partially recovered, likely easing policymakers' concerns about the need for urgent action. A key reason for this recovery was a sharp drop in short-term yields, leading investors to almost fully anticipate a 50 basis point rate cut in September, rather than the more modest 25 basis points. While Federal Reserve Chair Jerome Powell had previously downplayed the likelihood of a rate cut, the chances of a September adjustment now seem almost certain, with some speculating it could happen even sooner if economic conditions worsen. As investors grow more confident that a rate cut in September is inevitable, the uncertainty weighing on the markets has started to diminish.
Early that morning, so many people were coming on CNBC calling for, hey, we need an emergency rate cut. The Fed got it wrong. We need to cut. So what I was saying was going to happen the Friday before the weekend was happening on that Monday. Now, the Feds didn't come through. But I think because the markets recovered, they felt that they probably didn't have to. And one of the reasons for the recovery was yields. Short yields collapsed, and the markets began to price in a near 100% probability that we would get a cut in September of 50 basis points, not even 25 basis points. Powell brushed that off at the last press conference. But I said on my podcast that if we didn't get the emergency rate cut, we were getting a cut for sure in September. I just thought they may not even wait until September. They may have to do it sooner, and they still might, because we still have a long time between that September meeting and right now. But because the bond market started to price that in and rates went down, that helped the markets, because the markets saw this and they're like, okay, the Fed is definitely going to cut now. We no longer have that uncertainty of it's data dependent. The market now realizes that the Fed is going to move on in September no matter what. And that, I think that helped the market psychology. The market started to anticipate, okay, we dodged the bullet here. We didn't get the rate cut in July, but it's a done deal for September, so we can stop worrying about it. Now, of course, Powell would have looked a lot more prescient if he had done what I advised. Remember, on my last podcast before the Fed meeting, I said that I thought the Fed should have cut in July based on the economic data. Again, not because it's the right thing to do, but because I know what the Fed is trying to do. And I can see that the economy was weak enough that they could try to get away with a rate cut. And they can claim that, well, inflation is going to keep falling. Well, we've got to be concerned about the employment market, the economy. They missed that opportunity. But then when they did, I said, look, we're going to get a cut in September at the latest if we don't get an emergency cut before that time. So that helped the market recover. Everything recovered. Bitcoin recovered. Of course, it didn't recover everything, but it recovered. And then the markets pretty much rallied all week long, so that by the end of the week, you barely knew that we had that crash. In fact, the Dow was down on the week, only about 0.5%, maybe a little bit more than that. S&P was practically unchanged. In fact, I forget, it was down a little, up a little, but it was almost unchanged. The NASDAQ was down, I think, 0.2, 0.2% after being killed, right, on Monday morning. And some of the big tech names were just, just getting decimated, but they immediately bought the dip on Monday. The Russell 2000 was down about 1.4%, I think. Gold ended up settling down about $7 or $8 on the week. After all that volatility, it only closed down $7 or $8 on the week. The gold stocks, though, they got hit a bit. They were down 2% on the week, but they got shellacked on Monday. It was a great buying opportunity in those gold stocks on Monday.
In conclusion, Peter Schiff's perspective on the Federal Reserve's actions reveals the delicate balance the central bank must strike between reacting to market conditions and maintaining economic stability. Schiff's observations remind us that even in moments of market turmoil, the anticipation of central bank actions can have a profound impact on market psychology. The expectation of a rate cut, even without immediate action, can provide temporary relief to the markets, as seen in the recent recovery. However, Schiff warns that this relief may be short-lived if the underlying economic weaknesses are not addressed. As we look ahead to the Fed's September meeting, all eyes will be on whether they will follow through with the anticipated rate cut and what that might mean for the broader economy. Stay tuned as we continue to monitor these developments and their impact on the markets. Until next time, happy investing.